Mutual funds and exchange-traded funds, ETFs, are two common types of investment vehicles. While they share some similarities, they also have some key differences. This guide aims to provide a basic understanding of mutual funds and ETFs, how they work, and the pros and cons of each type of investment. Mutual funds are investment vehicles that pool money from many investors to purchase a portfolio of stocks, bonds, or other securities. When you invest in a mutual fund, you own a piece of the entire portfolio, and the fund's manager is responsible for selecting and managing the investments within the fund. Mutual funds are actively managed by a professional fund manager who makes investment decisions based on the fund's investment objective. When you invest in a mutual fund, you buy shares in the fund, and the value of your investment will go up or down based on the performance of the securities in the fund's portfolio. Professional management. Mutual funds are managed by professional fund managers who have the expertise and resources to make informed investment decisions. Diversification. By investing in a mutual fund, you own a piece of a diversified portfolio of stocks, bonds, or other securities, which can help to reduce your overall risk. Convenience. Investing in a mutual fund is convenient, as you can purchase shares in the fund through a brokerage account, and the fund manager takes care of the rest. Fees. Mutual funds can have high fees, such as management fees, that can eat into your returns. No control. When you invest in a mutual fund, you have no control over the specific investments in the fund's portfolio. Exchange-traded funds, ETFs, are investment vehicles that hold a collection of stocks, bonds, or other securities, much like a mutual fund. However, unlike mutual funds, ETFs trade on an exchange like a stock and can be bought or sold throughout the trading day. ETFs are passively managed, meaning they track a specific market index, such as the S&P 500, and aim to match the performance of that index. When you invest in an ETF, you own a piece of the entire portfolio, and the value of your investment will go up or down based on the performance of the securities in the ETF's portfolio. Low costs. ETFs have lower costs compared to mutual funds, as they are passively managed and have lower management fees. Diversification. By investing in an ETF, you own a piece of a diversified portfolio of stocks, bonds, or other securities, which can help to reduce your overall risk. Liquidity. ETFs trade on an exchange like a stock and can be bought or sold throughout the trading day, providing added liquidity compared to mutual funds. No control. When you invest in an ETF, you have no control over the specific investments in the ETF's portfolio. Market risk. ETFs are subject to market risk and can experience fluctuations in value based on market conditions. Mutual funds and ETFs are two common types of investment vehicles that offer diversification, convenience, and professional management. While mutual funds are actively managed and have higher fees, ETFs are passively managed and have lower costs. Ultimately, the choice between investing in a mutual fund or an ETF depends on your investment goals, risk tolerance, and personal preferences.